Hi and welcome to Annuity 201. In today's video, we're going to go into the mechanics behind a growth annuity and an income annuity. I'm your presenter today. My name is Doug Aumont. I am a certified financial planner. I am based in Parker, Colorado, happily serving clients nationwide. I take a CFP's approach to everything, and so we lead with education and we lead with transparency. The 5 mechanics you'll master in today's video are: 1, how a multi-year guarantee annuity, a MYGA, sometimes referred to as a fixed annuity, how that actually works. We'll discuss a 3-step framework every fixed indexed annuity is built on. We'll discuss cap versus participation rates. I'll break down the 3 parts of an income rider. And then lastly, we'll touch on why the carrier strength is the guarantee and why it's so important to underwrite the carrier that you're working with. So to kick things off here, we'll look at a growth annuity first. We're going to start with the simplest version. This is a MYGA, a fixed annuity. And so again, this is simple because we know in advance we have a fixed rate for a fixed term. And so in this example, we're using $500,000 with a 5.5% interest rate. Now the key here, this one is compounding. And so you can see by the example, every year the account value is going to grow when that interest is credited. And the 5.5% is now based on the larger account value. So at the end of the 5-year period, you're going to have $153,481. So we know exactly the starting and ending point. Now, assuming that you're not taking any distributions. Now, here's where people can get tripped up because they don't look at the fine print. And so not all MYGAs are created equal. Some have compound interest, others will use simple interest as their crediting method. And so you can see here in the example on the screen, it's a pretty significant difference. We're talking, $15,900, almost $16,000 difference by just that one piece. And so why is that the case? Well, if you look on the left, right, every year you receive interest, your account value's increasing in value. And so in the following year, the interest is now paid on a larger account value. And so you're going to have more interest. The interest continues to increase. That's paid out year after year. Again, assuming no distributions. However, if the fixed annuity that you've purchased has something called simple interest, you are receiving a straight line. Effectively, you're getting the same year 1 interest credited in the subsequent years, years 2, years 3, years 4, year 5, etc. And so at the end is where you start to see the difference. Now we're talking about 16,000 difference. So this is where, when we look at properly designing the annuity, this is one of the characteristics that we're going to look at is it paying compound interest or is it paying simple interest? We're also going to look at what access to that money do you have. In some cases, people will want to take distributions of the interest that's credited. In other cases, they'll want a flat percentage, 10% of the overall account value. And these are things that we'll want to understand. What are your liquidity needs? What's your time horizon? What's your overall objective before we even start looking at products? All right, so now here's, as we move on with a fixed indexed annuity, these are the 3-step framework that you need to understand. This kind of helps frame the concept of how a fixed indexed annuity works. First and foremost is protection. A fixed indexed annuity protects your principal from market losses. Now, this is going to be the same in really all fixed indexed annuities. They're all going to have this principal protection component. The second one, growth with limits. This is where it can get complicated, and this is where different products will have different crediting methodologies used. And so this is where it makes it harder to do an easy side-by-side comparison between one fixed index annuity and another, because you want to make sure that you're looking at the crediting methods, the indexes that are used, etc., because that's going to determine how your account value is going to grow. Remember, you're growing with upside potential, but you're not getting the full upside of the stock market. And then the third point, and this is a really important point, which the next slide will illustrate in a visual how this works, but your gains are locked in. So in year 1, let's say the markets were up, your account value receives a positive credit. In year 2, if the stock market has a pullback, well, you don't see any loss, so your gains are locked in. It's like an elevator that only goes up. And so here is a great illustration to show how this would work. So if you look on the chart here, starting at the same dollar amount, That faint gray line, that we're going to assume is the S&P 500, which is our proxy for the overall stock market in this example. So you can see in year one that that went up. Now, the key point is your account value is now tracing that black line. And so you're not getting the full upside, which is why that dot in year one is just below the overall market. Because remember, that's the trade-off. You're protecting your losses. And so what you're giving up is you're giving up the full growth potential. And here's why you're okay with that. Because now look at the example in year two. In year two, the markets have a pretty dramatic pullback, but your account stays flat. So that green and that orange dot stay the same. You don't have any loss of money, any loss of your principal. In years three, the market recovers. You're getting a step up in your account value as well, because again, you are getting to participate with a percentage of the upside that that market received. And then again, in year four, another pullback in the stock market, you have locked in those gains and are flat. And so now you can see the true value of putting a portion of your portfolio with inside a fixed indexed annuity, because you get to protect your money against market losses while still getting to benefit from market growth. And here's why that protection is so important, because the math gets pretty dramatic. So if you look at, in the first example, a 10% loss, which generally happens with regularity, honestly. So $100,000 drops to $90,000. You need more than a 10% gain to get back to even. You know, the math works out just over 11% is what the gain would be needed to get you back to square. When the losses are more dramatic, the recovery also needs to be more dramatic to get you back to even. So in this case, a 20% loss, you started with 100,000, you're now dropped to $80,000. You would now need a 25% growth in the market just to get back to even. And so as you can see, with the bigger pullbacks that we've seen, it takes a lot for the market to recover. And when you're in retirement and you don't have that time, or you're also taking distributions out, it can really magnify that issue. So this is why a fixed index annuity can potentially be part of your overall plan, because this right tile here, you see, when the markets are down, you're flat. All right, we've talked about this a couple of times here, a cap rate and a participation rate. Let me break them down side by side for you. And a cap rate is the ceiling. Think of it as the ceiling or the max rate of return that you can receive. Whereas a participation rate doesn't cap how much you can receive. What it does is it gives you a piece. And so a question I often get is, well, which one's better? And so we'll look at a side-by-side hypothetical so you can see which strategy wins in which market environment. So in our example, we're going to use a cap rate of 10%, and we'll use a participation rate of 55%. And so I have found that when you look at the actual numbers, it helps to clarify the concept. So in this first example, the S&P 500 has a down year. It's down 10%. And as we know, these are fixed index annuities that protect your principal from market loss. So in both cases, you're going to see 0% credited. You're not going to see any losses on your statement from the market. And so in this case, it was a wash. It didn't matter if you had a cap rate strategy or participation rate strategy, your interest was still going to be 0. All right, in year two, the market was up 6%. Okay, well, the cap rate is 10. That means you get to participate 100% up to 10%. So in this case, if the stock market was up 6% and your cap rate was 10, you got to return 6, the full 6. If you had a participation rate strategy, well, you only got to receive a share of the gain. So 55% of 6% is just over 3%. So in this case, the cap rate strategy would have won. Following year, you were up 12%. Again, with the cap rate of 10, that's the max that you can receive. So you get up to 10%, so you'd get 10% interest credited. In the participation rate strategy, you're still getting a share. So you're getting 55% of 12%, which is just over 6.5%. So again, in this case, the cap rate wins. All right, now in year four, we have a pretty big upside. The markets are up 25%. Again, the cap rate is fixed. You're locked in. You can't get above 10, so you receive 10% of interest. However, the participation rate, you get a share. You get 55% of that 25%, which means you're going to see 13.8% credited. So which one wins? The participation rate wins. And then in the last example, markets were up 34%. Again, with the cap rate, you get 10%. Participation rate, you get 55% of that total, so 18.7%. So you can see in years of big market growth, the participation rate is often going to outperform. In years of modest growth, the cap rate will often outperform. And in down years, it's a wash. They both protect your principal. And so this chart illustrates going back over 30 years, looking at the S&P 500, which strategy would have won. This is showing the actual rates of return over the past 30 years. The green bars are showing which years the participation rate strategy would have done better. The yellow or the gold bars are showing which years the cap rate strategy would have outperformed. And those red bars are when the markets were down and neither strategy would have received any interest in those years. And so what you'll see is the stock market oftentimes moves with big swings, both downward and upward. And so if you look at this, it says 13 of those 30 time periods, the participation rate would have outperformed. In 9 of those 30, we had more of a modest growth of the stock market, and the cap rate would have outperformed. And so what I often will counsel clients is I don't have a crystal ball, neither do you, and neither does anyone else. So instead of picking, is the market going to be up big or is the market going to be up little from year to year? I often will allocate a portion of your account to something that has a participation rate and something that has a cap rate. That way we can benefit in both market environments. And here's to illustrate what that can look like. So again, we're just going to use that 10% cap rate with a 0% floor using a $100,000 starting value. And in our hypothetical, right, the S&P 500 up 15%, we get 10% of that. So our account in year 2, the markets pull back. Good news for you is you don't see any reduction in your statement value. So it stays flat at 110,000. In year 3, the markets are up 6%. You receive that full 6% of growth. So now you're at 116,600. In year 4, the markets pull back, gains are locked in. So you're staying flat at 116,600. In year 5, if the markets are up 12%, you don't get the full 12. Remember, you're capped out at 10% in this example. And so you would receive interest up to 10%. And now that brings your total account value to 128,260. So the key takeaway here is you're getting protection for those down years. All right, so final piece here on the growth annuities. And it's very important to know that you are making a long-term commitment with an insurance company, but your money is not fully locked up, right? There are 2 ways you can access funds. One is with penalty-free access. So as we recall from Annuity 101, each annuity is going to have its own surrender period. The surrender period is the time commitment that you've made with that insurance company to keep your funds there. Again, generally speaking, 5 years to 10 years are what we look at. So, for example, you're keeping your money with the insurance company for 10 years. During that 10-year window of time, you will have access to penalty-free withdrawals. Most of the time, you can access 10% of your account value, right? So if you put $100,000 in every year, you're going to have access to roughly $10,000. Want to do a larger distribution for some reason during that initial surrender period, there's going to be a penalty. It's an early withdrawal penalty. And you can see here with those gold bars, this illustrates what that looks like. And oftentimes the surrender penalty will start off higher in year 1 and then gradually decrease throughout the term. And so if for some reason in year 1, you're taking more than that 10%, well, you're going to have a pretty substantial penalty to access those funds. And this is why it's really important that we talk about where does a fixed index annuity or where does a fixed annuity fit in your overall plan. Remember, it doesn't take your entire account. It takes a portion of your entire account. It's meant to do a specific job. You need funds outside of the annuity that can serve as emergency reserves, that can help pay for the roof or the car or the random medical bill or something like that. So that's why an annuity is part of a plan. It is never just the plan. All right, switching gears now to an income annuity. We're going to look at the mechanics of an income annuity. We'll start here with a graph. This is showing a hypothetical illustration. Your client started with $250,000 that they allocated to a specific job. Remember, that specific job was to create lifetime income, income that they can't outlive. So in this case, they were looking for $1,500 a month, $18,000 per year. So you can see that green line at the bottom. That's showing that $18,000 a year. And you can see your account value starts off at 250,000. Every year you are drawing money from your account. That account value is going to deplete, usually somewhere between 10 and 15 years. That account value will be fully drawn to zero. Now, that is not a flaw, that is by design. You have given this money a job. That job is to create a paycheck that you can't outlive. And so you can see here, even though at, your 80-year account value is gone, you're still getting that same $1,500 a month into your checking account each and every month for the rest of your life. And if you were married, you could have designed this for joint income, so the income payments continue for both you and your spouse's life. All right, within an income annuity, there's a couple terms that you need to be aware of. One is the income base, and we'll talk about this more on the next slide as well, but just know that the income base is an internal calculation used by the insurance company. You'll see it even reflected on your statement, but again, it's different than your account value. It's not something that you can actually access and withdraw. It's something that the insurance company uses when determining your lifetime income payout. The next point to know is a roll-up rate. This is something that happens when you purchase a deferred annuity and you buy the annuity, let's say this year, and you decide, I don't want to start income payments for 2 years. So every year you wait on the contract anniversary. So let's say you bought it on July 1st. So July 1st of the following year is your contract anniversary. You would receive a roll-up rate bonus. So your account value will change based upon the market growth that you have within the crediting methods you've chosen. Your income value, however, will increase by the roll-up rate. And so it's a piece and it's a component of what we're looking at. But again, we'll talk about later why it's not the most important factor. It's just something to be aware of what it is. And the payout rate. The payout rate, also referred to as the withdrawal rate or distribution rate, that's the percentage that's going to be used by the insurance company multiplied against your income base value. And those two numbers, when multiplied together, determine what your income, guaranteed income for life will be. And that payout rate will increase as you get older, but it also will potentially be less if you're doing joint life payouts versus single life payouts. And again, in Annuity 301, we'll show some specific examples and I can show you what those payout rates look like. All right, we've talked about this a couple of times. It's a really important point, is your account value is different than your income base value. Again, on your statement, you're going to see multiple values. Your account value, that's the actual amount that will be paid out as a death benefit if you were to die early. That's the amount that you could actually decide to walk away with. The income base value is simply an internal calculation that the insurance company will then use to determine what your lifetime income payout is. So oftentimes when we hear about bonuses that are applied to income annuities, these bonuses are being applied to the income base value, not your actual account value. It's also important to know that the rider fees and any other fees associated with the account, they're coming out of your account value, not the income base value. So here's an example. A common roll-up rate that I've seen is 7%. So again, by waiting, by delaying when you start taking income out of your annuity, that income value will increase by a guaranteed 7% each and every year. So the longer you wait, this is what helps to lock in a higher lifetime contractual payout. And so here is the most important calculation to keep in mind, as I talked about. The income base value multiplied by your payout rate equals your guaranteed income for life. So when we're looking at quote sheets, or you're hearing from an agent, or you're seeing a brochure talking about different bonuses or different roll-up rates, you can be confident in knowing none of that matters. It's just noise, it's a distraction, it's a marketing gimmick. All that matters to me and to you should be, what is the guaranteed income for life that I'm going to receive? All right, as we talked about, there's two primary bonuses I see. The rider bonus, oftentimes applied specifically to your income base, so it allows that income base value to grow faster. In other cases, I'll see a premium bonus. That premium bonus is oftentimes applied to your actual account value. But when we look at, again, if we're solving for guaranteed lifetime income, these are important to be aware of, but they're not the key determining factors into which product is going to be best. Because oftentimes what I've seen is a product that has a higher premium bonus may have a lower payout rate. And so what effectively is happening is you're having lower guaranteed income. And so it's not designed to do what we want it to do. We want to maximize our lifetime income payout. We don't necessarily want just a premium bonus to maybe increase the death benefit if we were to die early, because that's not what this money has been assigned that job. And so really, I know we've touched on this a couple of times, and it stands to worth repeating because it's something that I hear literally in every conversation I talk to prospects and clients and people about income annuities. Is it's very enticing to get caught up in the bonuses, to get caught up in these different variables like the roll-up rate. But what ultimately matters is what's going to hit your bank account each and every month. And that comes from this simple formula of income base times payout rate. So I don't care what the bonus is. I don't care what the roll-up rate is. I and you only care about one number. What is the contractual lifetime income payout? And when we're looking for the highest payout from a financially strong company that's stable and it's been around for a while. And with lifetime income, we're effectively committing for a really long-term relationship with this company, right? I mean, we're hoping to receive payments for 20 plus years. And so we want to verify the financial strength of the company. We're going to look at different rating agencies to confirm that they have high credit, that they haven't had any downgrades recently. We want to make sure that they have a long track record. They have an operating history that's been able to go through different presidential elections. They've been able to go through different interest rate environments, whether interest rates were low like they were a decade ago or higher now. We want to make sure that they have stable ownership, that they have reserves on hand, that remember, when your account value is drained to zero, they're still on the hook for making those payments to you. And that's the longevity insurance that having an income annuity can offer you. So we want to make sure that that company is going to be around so that those payments continue for the rest of your life. And so to tie this all together, an income annuity is unique in the sense that you're going to watch that account value dwindle down. For a lot of people, this is challenging because they're not used to seeing their account values go down. Remember, for the past 30, 40 years, you've been saving, you've been watching your account values grow. And so that mindset shift is really challenging to realize, oh, this money that I've taken out of my overall portfolio, right? I've taken a piece and I've wanted to apply it to the job, and that job is to create a paycheck for life. I expect that account value to get drawn to zero. And the benefit is when that account value is at zero, the insurance company is going to continue making those payments to me for life. Now, God forbid something happens to you early on and your account value is not drawn to zero. Well, whatever's left in your account value will get paid as a death benefit. So when we build these, we don't go into it thinking you're going to die early, because if we were worried about your health or worried about premature death, then an income annuity would not be appropriate for you. But we want to know, if we do have something happen, what happens with that money? And it doesn't go back to the insurance company. In most cases, the way we design that is that the account value gets paid out as a death benefit to your heirs. And if you're married, the income stream could be set up to cover both of your lives. Now, there is a trade-off. If you do want to cover both of your lives, you're likely going to have a little bit lower starting payout rate versus if you only covered your life as a solo. All right, that was a lot of information we covered. I'm going to do a quick 3-question multiple choice knowledge check just to see what stuck. All right, question 1. An income rider's annual fee is deducted from where? Is it A, your income base, B, your account value, C, your Social Security, or D, nothing? The rider is free. And if you paid attention throughout, you'll know that the answer was B, your account value. Your account value will get drawn down quicker with these rider fees. There's no disputing that. An account, however, without a rider fee will have a lower payout. So again, this is just a personal preference. If we have an inherent disdain and we just don't like fees, well, I can show you different products that don't have fees, but I will tell you this, those products will have a lower payout. And so by design, we have decided, okay, this portion of our funds are going to be applied towards income for life. I want the highest maximum contractual payout. I'm okay knowing that that account value is going to be drawn to zero because it's not the goal of legacy. It's not the goal of growth. That's what my remaining portfolio assets are for. All right. Number 2, 2 MYGAs, multi-year guaranteed annuities. Both are advertising 5.5%. What actually decides your outcome? Well, is it A, the stated rate alone? Is it B, whichever has the bigger brand? Is it C, the guaranteed value at the end of the term? Or is it D, the first year interest? And the answer is C, the guaranteed value at the end of the term. If you recall back from our example, a MYGA with a compound interest versus simple interest, how there was almost a $16,000 difference over just a 5-year period of time. And so look at the contractual guarantees, not just the headline interest rate when comparing products. All right, last question. When comparing income riders, the number that matters most is A, the roll-up rate, B, the premium bonus, C, contractual lifetime income payout, or D, the highest cap? And the answer is C. The contractual lifetime income payout is by far the most important number. The rest of those numbers, as I mentioned, are distractions, marketing gimmicks, variables that are relevant to be aware of, but honestly don't carry the weight of the ultimate decision because we're looking for financially stable companies with high contractual guaranteed payouts. All right, and then the last slide. I appreciate you sticking around all the way to the end. I'm going to keep this up here for a moment, but the short version is simply this. This is education. This is not tax advice. This is not legal advice. This is not investment advice or financial advice. And there's a lot of nuance when you look at annuities. There's a lot of terms to understand. And so I create these as a way to introduce the concepts to you and to see where an annuity potentially can fit. But ultimately, what's going to make the most sense for you is going to be personal. And so that's where we have those complimentary one-on-one Zoom meetings. We'll talk about what's most important to you. What goals and objectives do you have? What liquidity needs do you have? What expenses? All of those variables are very important to determine where an annuity fits, if an annuity fits. And then from there, we'll start to look more, do we look at growth annuities versus income annuities? And then from there, we'll look at the different products. And once we get to that level, that's when we'll start to look at the details in the contract to see, okay, of these different contracts, how exactly do they work? Because if you recall back in my first video, Annuity 101, that coffee shop example, I want you to be able to, with confidence, explain back to me and then explain to someone in your family or a friend at a high level without divulging anything personal, why you're making this decision, what an annuity's role in your overall plan is, and why it makes sense for you. And that way you're empowered to know that you're making an informed decision and you're being very intentional with the way you're approaching your retirement. And that's how you and I will work together. All right, I'll catch you on the next video.